Well, emerging market stocks have now erased their 2010 gains, with the Bovespa in Brazil especially under pressure this week, down more than 4.2%. The concern there is China. So joining us now with his outlook on these markets is David Lazenby. He's head of emerging markets for Batterymarch Financial. His fund has been beating its peers, and he joins us now from Boston. Thanks so much for joining us, David. The sell-off in Brazil on the concern that China will tighten its lending and slow its economy down, is that justified?
Well, it's certainly clear that China has an impact on Brazil and on the rest of the emerging markets world with regards to being a growth driver. China is a marginal buyer of most of the goods that countries like Brazil export, particularly in the commodity space. The reflation trade is largely driven by that Chinese demand. In the emerging market space, 30% of the index is actually in materials and energy stocks. And Brazil and Russia and some countries of that sort are certainly very heavily leveraged or exposed to that Chinese demand.
Do you see this decline continuing then as people try to figure out what China is going to do, whether this is just talk or whether there will be action?
Well, I think the key thing to remember is that this is a preemptive tightening on China's part, recognizing that the growth numbers that have come in recently have come in above what the expectations were, and therefore people are concerned that there may be an overheating in the Chinese market. But what we need to remember is that there have already begun some of this preemptive tightening prior to the announcements that we've seen this week. So the fixed asset investment has already declined relative to where it was, say, in the third quarter. They've already started the process. Typically what happens in the emerging markets world, and I think this is largely true globally, is that the initial tightening or the initial concern about tightening creates a market reaction, a negative market reaction, but the reality is that you actually generate decent returns in the equity markets from that point forward until you get closer to the end of the tightening cycle. The initial tightening is due to expectations of overheating, but in an environment where growth is still strong. When you stop tightening is when the growth has slowed down, and that's when things for commodity exporters, et cetera, are really more difficult.
So how long is this tightening cycle going to last?
That's a difficult question to answer. We haven't even, obviously started the actual monetary policy tightening in terms of interest rate changes. The current consensus expectation on China is that probably doesn't start until the second quarter. So we haven't even really begun any meaningful tightening yet. So how long will it last is very difficult to monitor. But what we do, very difficult to predict. But what we do need to do is monitor those interest rate changes, not just in China, but across the world. There are only a couple of markets thus far, as you know, in the developed world, Israel, Australia, that have tightened yet. The expectation still is that most central banks, developed and emerging, are going to continue to be relatively easy in the near term. So I think we're in the very early stages of this process. Okay,
now with China in the preemptive parts or the early stages of its tightening cycle, you say in your notes that it's less of a clampdown and more of a return to normal conditions. So does that mean that normal growth as well, rather than a sharp slowdown for China?
That would be our expectation. China's been reasonably good, certainly over the recent past, of managing their economic conditions. So they stimulated, as did most of the world economies or policymakers last year. What they're doing now is, as you said, just bringing us back to more normal conditions, recognizing that the policy stimulus has done its job and that now other things are kicking in and they need to be careful not to overstimulate. So now they're beginning to bring that in. Our expectation would be that you'll continue to get normal growth. In fact, if anything, the concern now is that you'll be well above that long-term sort of 8% number. And the concern is the magic number on the other side, which people seem to be talking about 11% as being the risk when you really are concerned about overheating. So yes, I would expect there will be normal growth in the interim.
Okay, and very quickly, David, you talk about how you see opportunities in the Middle East. How did the Dubai debt crisis make the region more attractive?
Well, I think the simple answer to that is that the valuations are lower than they were before the crisis. The key thing, though, that we need to remember is that in Dubai, in contrast to many other countries where they have had sovereign risk difficulties, and largely those tend to be today in the developed world as opposed to in the emerging world, Dubai has coverage. They have funding, they have resources, even if those resources are coming from their neighbors in the Emirates.
All right. We thank you for your time and your thoughts. We've been speaking with David Lazenby, head of emerging markets at Batterymarch Financial in Boston.